Well, good morning then, folks, on Wednesday, the 2nd of August, as we are now an hour into the European session and have had a little bit of time to digest the downgrade of US credit. Fitch, obviously a credit ratings agency, have downgraded, as I said, US credit. Now they've pointed towards the repeated debt limit, political standoffs, and last minute resolutions that have eroded confidence in fiscal management. Now they keep reaching the debt ceiling. They did reach the debt ceiling a few months ago, had a bit of to and fro between the government, and then came to a last minute agreement. Now the credit rating agency does not like that and has downgraded their credit rating. Credit rating happened, the last time they had a debt standoff back in kind of 2011, 2012, around those sort of times. Now they don't seem to like that, right? They did say, the expected fiscal deterioration over the next 3 years, a high and growing government debt burden, and the erosion of governance. I mean, obviously, there's a debt ceiling in place for a reason. They have a debt ceiling in place so that the government don't just keep creating money and pumping money into the economy unlimited amounts. They do have to control the amounts, but they reach this debt ceiling and they just raise the debt ceiling. So it's kind of pointless having a debt ceiling in the first place. I mean, they've risen it 70 odd times in history, and they always seem to come to some sort of agreement at the end. And obviously the ratings agency don't like the fact that they leave it so late. Come to the last kind of days, there's a risk of default in the country, and they have downgraded the credit rating off the back of that. Now that has caused some downside in stock markets. Hasn't really impacted the US dollar too much. Now, some market participants don't think this is going to be a long-lasting problem. I mean, the debt is still backed by the US government. So yeah, they can raise concerns about how the debt ceiling is raised and stuff like that, but ultimately this debt is still backed by the US government, and the US government does still or is still able to control the debt ceiling and the outgoing of money from the government. So there is obviously a bit of downside in stocks, but whether it's long lasting, I'm not really too sure. But we'll have a look at it once we get around to some charts, and the we will see the reactions to it. But US stocks down. They've had a solid bit of downside, certainly in the last kind of 5 or 10 minutes. Stock index is down across the board. If we flick over to the grid and have a look, you can see US stocks, European stocks, Asia Pacific stocks all lower across the board. And that is what was really in focus this morning. US yields are down slightly, so bonds purchased off the back of a bit of safe haven flows, but not exactly massive moves across that, not massive moves across the US dollar. Really, it is confined to equity markets at the moment. Now, the Australian dollar, Kiwi dollar are down as well. Australian dollar, obviously concerns, well, I say concerns, but no more interest rate hikes, or markets believe potentially no more interest rate hikes from Australia. Come to New Zealand, potentially no more interest rate hikes from New Zealand as the jobless rate has climbed overnight. So a bit of negativity on the Australian dollar, Kiwi dollar off the back of their individual economies. Expectations for no more interest rates. Couple that with the fact the stock indexes are down across the board is a pretty good recipe for some downside in the Australian dollar. The Japanese yen is bid across the board off the back of some safe haven flows as well. Now we'll flick across to the charts and we can have a quick look. You can see the US dollar not really doing too much. Aussie and Kiwi are down, but that's really an Aussie and Kiwi move. You can see Euro dollar cable not really doing too much. Dollar Swiss has popped higher, dollar yen a slight bit lower, dollar CAD's a bit higher. So nothing really too much off the back of that in terms of the US dollar, but you can see stock indexes are selling off quite heavily over the course of today's session so far. The DAX, the Euro stocks, the FTSE all aggressively lower. The S&P, the Dow, the Nasdaq, the Russell all now aggressively lower. The VIX then popping up now above 16. So some clear risk off trading in terms of the equity markets. Bond yields not really affected too much, and even the 10-year slightly higher over the last hour or two. 2-year yield slightly lower. You can see oil has moved lower, likely to be in line with the stock index downside, and you can see some Japanese yen strength then off the back of that as well. So really it's confined to just equity markets at the moment. Equity markets look negative, and I don't really want to be buying into that just yet. So probably where you'd like to focus your attention, downside in equities to come. Obviously you're pretty aggressively downside on the DAX, the Euro stocks, and the FTSE, but S&P, Dow Jones, Nasdaq, and the Russell are playing catch up at the moment. You come across to the calendar, there's not really a great deal out over the course of this morning. You can see this New Zealand on the chart. You can see these. Flick this around, sorry, slightly. You can see once you come down here, the unemployment rate, quarter to 12 last night. Employment change still slightly higher, but the unemployment rate has ticked up. So you'd be fair, previous 3.4%, 34% unemployment rate would be chaos in the economy. But 3.5% consensus actually has come in above a 3.6%. So unemployment rising in New Zealand, then causing market participants to believe that interest rate hikes are concluding in New Zealand, which is obviously the reason for Australian dollar, Kiwi dollar downside in today's session. Couple that with the fact that you had the RBA out yesterday holding interest rates steady for 2 consecutive meetings. Couple that with stock index downside, again, as a reason for downside in the Australian and the Kiwi dollar. So Australian dollar, Kiwi dollar, good bets for some further downside. Equity markets under pressure as we have gone into the European session. So negativity across markets today. Stock index downside seems the way to play it. I wouldn't want to just buy back into these, especially after developments with Fitch downgrading US credit rating. So stock index downside, does that continue is a bit of another question. I don't expect it to be too long lasting, as that debt is still backed by the US government, but we are negative on stock indexes as we head into, or as we have headed into, the European session today. Stock indexes firmly pointed to the downside, and as long as that remains the case, that is how you would have to view trading over the course of today.